I'm Aoifinn Devitt, CIO at Moneta. Inflation has been a dominant theme over the course of 2021. As we approach the end of the year, we've recently seen inflation reach 39-year highs. Earlier in the year, we recorded a podcast in which we discussed methods of making a portfolio inflation resilient. I hope you enjoy our conversation.
Welcome to Moneta Moneywise, where our CIO, Aoifinn Devitt, discusses timely topics with subject matter experts to build your financial wisdom. And now, here's your host, Aoifinn Devitt.
I'm Aoifinn Devitt, CIO at Moneta Group, and welcome to this Moneta Moneywise podcast. We're here today to discuss inflation and take a look at how portfolios might be inflation resistant. I'm joined today by Georgy Popov, who is a Senior Vice President and Product Strategist in the PIMCO Newport Beach office. He focuses on both liquid real asset and defined contribution solutions, including target date funds. He previously was a member of the US Financial Institutions Group. Prior to joining PIMCO in 2013, he was a macroeconomist at Nationwide Insurance, developing quantitative models and forecasts. He was also a member of Nationwide's Economic Council. Welcome, Georgy. Thanks for joining us here.
My pleasure.
Well, great. Well, can you start maybe by painting a picture of inflation in markets today? What do you think is going on?
Inflation is probably one of the hottest topics that we are seeing today for a number of reasons. The first one is that inflation prints are very high. They're high in absolute terms, but also high given the historical context. So what am I talking about? The latest headline CPI print for the US came at 5%. And over the last 10 years or so, inflation really has been hovering in the 1 to 2% range. So definitely a much different period. And portfolios are realizing that inflation could be a larger concern going forward, given where we are today. The second reason why this is also a hot topic is because many portfolios are realizing that they are a little bit light on inflation protection. And that's very expected, given that inflation was not a concern over the last 10 years. So allocation to inflation protection and real assets has drifted lower than the long-term structural target. So now there's this process of recalibrating to the new normal where inflation is.
Yeah, my question was around what about the popular narrative that this is a transitory effect, that as we emerge from the COVID shutdowns, perhaps there were supply chain shortages, or in some way supply chain disruptions, that this is transitory. And this certainly seems to be the narrative of the US Fed. What are your thoughts on that?
The Fed has came out and said that this is transitory. PIMCO's headline view also is that inflation is peaking. But the devil's in the detail. What does that mean? Because we'll have another CPI print for the month of June that will be published next week. And we do expect that print to be even higher than 5%. And perhaps for inflation to remain over 4% for the remainder of 2021. So yes, we're unlikely to see inflation accelerate from 5% to 6, 7, 8, 9%. But we're also unlikely to see inflation return to the 1 to 2% target. So in the near term, we expect it to be elevated, as I mentioned, over 4% by the end of this year, perhaps even over 3% by the end of next year, and only slowly reverting back to the Fed's target. But the path towards the target will be slow and bumpy. And if anything, the risk of inflation surprise to the upside is much higher than the risk of inflation surprising to the downside. So even if you have a relatively sanguine base case for inflation being transitory, the risk of being wrong is definitely tilted to the upside than the downside.
Right, and we also have the question with how do you define transitory? I mean, transitory could mean a month or two, and you seem to suggest that it could be high for the rest of the year. And markets tend to have quite short-term time horizons. Do you think that would be a negative surprise for markets?
I think so, and we have seen that happen over the last 4 or 5 months. Every time we had a new CPI release, the market upped their forecast. And those revision upward in forecasts were quite sizable. And even, the Fed recognized that they need to move more aggressively to manage the risk of higher inflation. So they started to talking about exiting quantitative easing. They pulled forward the expectation for the first rate hike, which caused the market to correct, and I would say perhaps even overcorrect in their expectation for where inflation is. And inflation never really moves in such a kind of proper and well-behaved way. If we look at surprises in inflation in history, those are quite sizable. I'll give you an example. The survey of professional forecasters, they publish their inflation forecast 1 year out. And we have data going back to the 1970s. And of course, we have actual inflation. What was the inflation print a year later? And what you see that in roughly 40% of the time, their forecasts were off by more than 1%. So actual inflation was either 1%, more than 1% higher, or more than 1% lower than what they forecasted. So even if you talk about professional forecasters, only 12-month investment horizon, they still got it wrong 40% of the time. So we need to be humble about our ability to forecast inflation.
I love that you spoke about inflation not being well behaved, since we've also talked about inflation markets having an inflation tantrum. So I think that's just a nice image to think about it as a kind of unruly child, perhaps, that we can't predict where it's going to go. I just want to get back to the measurement point, because you spoke about a 5% level, which clearly is quite a bit above what we've been led to expect. Do you think that we're looking at the right base year? Like, is the base year artificially depressed? So could there be some smoothing done that would look maybe back 2 years in terms of the price level that might give us a better sense as to what's really going on?
Sure, that definitely will help with kind of the shock of the number. So we call it the base effect, right? Because it's an year-over-year number. Inflation was very depressed last year, which means that today, on a 12-month change basis, it looks high. But it's not only the base effect, right? When we're looking at month-over-month change in inflation, that has nothing to do with base effects. We have seen some sizable jumps to the tune of almost 1% month-over-month change. And in some cases, that was driven by only a small fraction of the goods and services. We've probably heard a lot of talk about airfare that has risen, basically correcting to the normal, and also used car prices given the shortage out there. So some of these will be transitory, and that definitely is what the Fed is emphasizing, and again, what we're reinforcing at PIMCO, but it's not the full picture. So if you remove base effect, you still have inflation that is elevated, inflation that signals that we are in a recovery period, and we're probably approaching somewhere the mid-cycle where growth is improving. And this year, PIMCO's forecast for real GDP growth is over 7%. And when you have strong growth, then you expect inflation to follow. So inflation is a lagging economic indicator, right? So it means strong growth today will be a tailwind for inflation going forward.
And just let's get into the basket a little bit, because obviously we look at the average price, right? Are there certain areas where price rises are quite a bit steeper than that headline rate, or are there areas where it's lower, perhaps?
Yes, yeah. So the main example that we hear a lot about is used car prices that have been driving prices higher. And again, we think this is transitory. We're also seeing gasoline prices. I mean, they're up over 50% over the last year. Gasoline is a very small part of the CPI basket, but if you have a 50% change on a year, that still contributes almost 1% to CPI. So that's why if you look at the difference between headline CPI, that includes food and energy, and core CPI that excludes these more volatile sectors, you see inflation that's kind of in the 3.5% to 4% range. Again, elevated, but not as high as headline. On the flip side, you have what's called owner equivalence rent. basically back in the 80s, we stopped including housing prices in the CPI basket because houses were being viewed more as an investment, not as a kind of property where you live. So that was supplemented, or I should say replaced, by this owner equivalent rent, basically how much it costs you to live. And owner equivalent rent has been very low and has been kind of dragging inflation down, or it has not been contributing to inflation. And that is a meaningful part of the basket. About a third of the basket is represented by that OER.
And just before we move into portfolios and how they might be arranged in order to take advantage, or at least be resilient for inflation, can you just shed some light on the global picture? Is this a global phenomenon, or what would you say on that?
It's a global phenomenon, but much, much more pronounced in the US by far. And the risk of inflation overshoots long-term are also the highest in the US. And that has a couple of different factors contributing to it. One is just the peak in economic activity. It's occurring in the US much faster and sooner than in Europe and the UK. They're still dealing with the negative consequences of the coronavirus, and reopenings are much slower to happen. We also have in the US, up until very recently, almost unlimited ability and willingness to provide monetary and fiscal policy stimulus. That's something that Europe just cannot afford because they don't have united fiscal policy across the union. So the risk of overshoots is highest in the US, but we expect stronger inflation across the globe as well, but nowhere near as high as here.
And let's look to investors now. Why should investors care about this? What way is an investor's portfolio exposed to inflation?
Sure. So inflation is a very interesting area because inflation comes as a surprise to portfolios. And by the time you really see inflation in the CPI numbers, it's either too late to protect against it or too late and too expensive to hedge for it. So you really need to be thinking about a strategic exposure to inflation protection. Now, in some cases, that may be a bit challenging for returns, and that was the case over the last 10 years, when if you did allocate to some of those inflation fighters, perhaps you would have been better off by loading into equities that have done so well, with the benefit of hindsight, of course. But there's something to be said about a well-diversified portfolio and having exposure to inflation fighters. The second thing, and this thing is important to mention, is that if you look at the correlation between stocks and bonds, that correlation typically is negative. So let's say negative 0.2, and that's what we want. That's what produces diversification in portfolios. But when inflation is either high or rising, the correlation between stocks and bonds also rises. And currently we are seeing that the correlation between stocks and bonds is at the highest level in 20 years, which means that diversification benefits weaken when inflation is either high or rising. Now, if you look at the correlation between inflation fighters, for example, US TIPS, Treasury inflation protected securities, and stocks, S&P 500, that correlation typically is around 0, but the correlation becomes more negative when inflation is higher rising, which means you have higher diversification benefits precisely when you need them, when inflation is on the uptrend. But the allocation to inflation fighters should be carefully scaled to something that the particular investor is comfortable with.
You use the term inflation fighters. How do you define that exactly?
So inflation fighters are assets that have a positive sensitivity to changes in inflation. Sometimes we call that inflation beta. Basically, when inflation surprises, which asset classes have a positive change in their return given the change in inflation. To give you an example, US tips have an inflation beta of roughly 1. And that's very intuitive. The principal of tips adjusts with changes in CPI. So when CPI changes, the principal adjusts. So they provide one-for-one protection from higher inflation. You also have other real assets such as commodities that have an even stronger change to change in inflation. And their inflation beta is in the neighborhood of 7 to 8, which means that when inflation surprises to the upside, commodities respond in a very strong way. And in many cases, commodity price increases are the driver of higher inflation.
Very interesting. Well, at this point, I want to just note that we do have some guests on the call who might really have an interest in getting into the meat of this conversation. So whenever anyone does have a question, please just raise your hand and I'll be happy to come to you. But let's get back to that idea of inflation fighters. Let's use that term instead of an inflation hedge, because I suppose the question is are there any real truly effective inflation hedges out there? And do some of these characteristics, such as maybe commodities having a positive correlation with inflation, do they change over time? I mean, that may have been the case in the last crisis, but is it the case today? Is it a kind of a variable correlation?
The correlation is pretty stable over time, but of course, commodities are a group of many different sectors, of course, and over time, we as an active manager really kind of change which of the commodities are our favorite sectors. But the correlations and that inflation beta is pretty stable over time.
Let's go through different asset classes now to see what are some of the kind of characteristics of them that might be good, make them good inflation fighters. What about equities? Would you consider equities are good at fighting inflation, or does it really depend on the sector?
I would say it depends more on your investment horizon. So over the very short term, equities have a negative inflation beta, which means that if inflation surprises to the upside, you do expect equities to underperform. And we have seen that earlier this year, big shock to equities as inflation was rising. Now, over the long run, equities, of course, are an asset class that is tied to the health of the economy. So you have high inflation when you have a healthy economy, growing economy. I mentioned this year we expect real GDP growth of 7%, right? If that growth is 0, we're not going to have high inflation. So over the long run, equities will perform well. Equities, through equity earnings, that will be positive when you have a high growth environment and inflationary environment. That will do well, but not in the short term. So they will not protect you from kind of shocks to inflation. But if you want to hold something for 20 years, we do expect that equities will outperform the level of CPI over that 20-year period.
And let's move now to core fixed income. Typically, you would think that might perform poorly in an inflationary environment. It might actually be rather a good deflation hedge, so the other type of environment. What are your thoughts on a core fixed income allocation in an inflationary environment?
Yeah, so similar to equities, core bonds, nominal bonds, also have a negative inflation beta, which means that in the near term, when inflation rises, core fixed income will underperform, and that's also what we saw earlier this year. So if you think about equities and bonds, they do a good job of diversifying the growth environment in which we're on, right? Equities do well when growth is high, bonds do well when growth is low, but both of them will underperform if you have a short-term spike in inflation. And that's when you really want to have exposure to real assets in the portfolio. Now, you did provide very astutely the comment that it also depends on the horizon. So if you have higher inflation, that probably means higher yield. So over the long run, the yield and income bonds can generate will improve, right? So as rates rise, certainly bonds have duration, so rising rates are negative for bond returns. But eventually, when the market reprices and bonds start to produce higher yield or income, that will be beneficial for bondholders. Again, we have a perfect example of that now, where core fixed income yields very low. If you are relying on an investment like the Barclays Ag for retirement income replacement, you're in a tough spot. 1.5% yield when inflation is so high is not a good place to be. And hopefully, in the future, we can have higher yields and higher ability to generate retirement income. In my job, I follow some of these trends, and I realize that that's of heightened concern for people.
How about this kind of unusual juxtaposition we're at today, where we do have high inflation, but it also doesn't look like interest rates are going to be rising either? So I guess those higher yields you spoke about may be a little bit farther away than we thought.
That's right. So the Fed has committed to keep rates low. The latest forecast that they put out there says that they'll raise rates in the middle of 2023, which means that nominal yields are likely to remain range bound. At the same time, if inflation surprises to the upside, you could have higher break-even inflation, which means that real yields will move lower. So you can have nominal yields remain flat and real yields rally or fall even further. In that environment, of course, TIPS will outperform nominal treasuries on a maturity-like basis.
And let's move now to a segment that I think you think are good inflation fighters, so real assets. Can you talk us through the types of real assets that you think are good inflation fighters today?
Sure. So there's a full spectrum of those real assets, and sometimes investors pick one of those assets. Sometimes they pick a portfolio or a basket of those. It really depends on, what are your liabilities, how much duration you need in the portfolio, what are your objectives as far as diversification, and also how does that real asset allocation fit in the context of the rest of your portfolio. So I'll give you examples. If you start on the kind of the spectrum of inflation protection from the lowest volatility and highest connectivity to inflation protection, that's TIPS. As I mentioned, TIPS, US government issued treasury securities, their principal adjusts with inflation. So they provide a 1-for-1 hedge to inflation. But they're US treasuries, right? Their expected return is fairly low. If you move a little bit on the risk spectrum, then you have commodities. Commodities don't have this contractual link to CPI changes, but what we see in practice is that commodities have a very high response to changes in inflation. I mentioned inflation beta of 7 to 8, but that also comes with higher volatility. Commodities have volatility of, call it 15, 16, 17%. Within commodities, they're very heterogeneous field. Currently, we like industrial metals the best. As the economies reopen, demand is rising. Demand for industrial metals that are being used in production of goods is rising, and we are seeing pretty sizable opportunities in that segment. Also, on the energy side, we're closely monitoring kind of what happens, but the demand for oil has risen as well. So that's commodities. You can also look at other inflation hedges such as REITs. So REITs, they're part of the equity capital structure, and they're tied to properties, strip center, malls, data centers, cell towers. Interestingly, in the very near term, REITs have very low inflation beta, because in the near term, call it 1 to 3 years, REITs behave much more like equities and less like real estate. But if you hold them over 3 years, we see that REITs in the long run behave much more like real estate and much less like equities. And that's, of course, we see that by observing correlations. So in the long run, REITs are a good inflation hedge, and they also provide a pretty consistent source of income to investors. Currently, if you look at valuations across all the asset classes, REITs are probably some of the most cheaply and attractively priced asset classes. I mean, they were beaten so much during the pandemic that we find very, very good opportunities. Now, you still need to be selective. Some of the REITs that are cheap, there's probably a reason for it. Demand for office space has declined, absolutely, but demand for cell towers, hotels is rising, data centers, etc. There are some sectors of the REIT space that are poised to outperform in a very, very big way.
I have a question from David there, so I'll just turn to David and then we'll come back to that list, but thank you. David, go ahead.
So one could argue that we invest in a forward-looking market. And so if higher than average inflation is expected amongst a majority of investors, are there any of the inflation hedging performance already priced in? Or do you still believe that it'll still be a very, very similar correlation going forward still?
Yes. So for example, in tip space, that really creates attractive opportunities on the curve, right? So you do have market's expectation for inflation over the next 3 months, 6 months, 1 year, 3 year. And what we are seeing is that actually over the next 2 months, PIMCO's forecast is higher than the market forecast. We think inflation will be over 5% for the next 2 months. The market is expecting much higher repricing. But then in the long run, so after 5 years or longer, the market is forecasting that inflation will be at the Fed's target, 2 to 2.5%. We do think that there's a meaningful chance that inflation really kind of overshoots that target. So the way we do it in our portfolios, for example, is we have a favorite part on the curve. We prefer the 10 to 25 year part of the break-even curve for the US tips curve, and we're actually underweight the very front end of tips. Now, they seem very, very underpriced to the tune of maybe 20% cheap versus our internal valuation models. There again, it's active management that drives this, but valuations are very cheap. Now is a good entry point in that space.
Great, thank you. Well, maybe you were ending on REITs. Were you moving down a list of real assets there that you want to get back to?
So yeah, I was going to say it's also possible to invest in a basket of real assets. Sometimes investors say, well, I don't know if I want tips or commodities, and those two are very different asset classes. I mean, very different risk profile, or REITs or MLPs, or floating rate notes or currencies or gold. Can you help me? Can you do it for me? So there are a number of different products that create baskets at PIMCO, and I won't go into detail of exactly what it is, but we have a multi-real asset product that basically combines a basket of 5 different inflation fighters. It's an all-in-one inflation solution, and we decide kind of how much to allocate to each of those asset classes, which one to underweight, overweight, and that portfolio really is designed to provide not only inflation protection, but also diversification to what you have in the rest of your portfolio. So most portfolios are pretty heavy on US stocks and also core fixed income. So this multi-real asset portfolio is designed to be a good complement to it. But there are a number of different flavors.
One more asset class I want to ask you about, which I know is very typically used in Europe and Australia as a good inflation hedge, is infrastructure. And you mentioned contractually linked cash flows that are linked to CPI. I know in infrastructure, say toll roads or other kind of developments would have contractual payments that are specifically linked to inflation. What do you think of that as a good inflation fighter?
Sure, infrastructure is very, very popular, as you mentioned, especially overseas. Here in the US, what we most often allocate to is MLPs. So they're tied to the energy infrastructure, and they're a very liquid way to express that position. Sometimes we shy away from some of the less liquid infrastructure unless it's in more of a kind of a private type arrangement where you could afford the lockup. So very attractive. There is a role in the portfolio for it, but you have to be mindful of the liquidity profile of those investments.
And my last question is one, it's actually getting back to some of the commodities you mentioned and some of the maybe the energy assets, which might be seen as real assets. In light of the increasing focus on ESG and on decarbonization and on perhaps less reliance on fossil fuels, do you think that some of that complex is more difficult to value today because it's so hard to forecast out perhaps the cash flows of those companies because of this renewed shareholder focus?
Yes, absolutely. The ESG trend is very strong. We are absolutely convinced that ESG is the future. More and more focus on climate change. Regulation will also make some of those investments much more expensive in a way, which could ultimately lead also to higher inflation going forward. So right now, I don't see immediate concerns as far as how to value those commodities, but certainly is a headwind, and it's a trend that we absolutely believe is going to happen. The train has left the station.
Very interesting. Well, Georgy, thank you so much for coming here and giving us this rich and detailed snapshot of where we stand in terms of inflation today, not just in the US, but also globally. I think it's very interesting to hear the PIMCO forecasts of real GDP of 7%. I think you said for this year or next year, it was 7%, 2020. Yeah.
2021 this year.
2021, yes. So that's quite a buoyant forecast. So, and if inflation is a lagging indicator, well, then we can, I suppose, we can look forward to at least ongoing high inflation prints, and be interesting to see how the Fed interprets them. So, thank you so much for coming here and sharing your insights with us.
It has been my pleasure. Thank you.